Wednesday 16th of November, and pretty interesting start already to the session. Some decent price action. If you just check out, I don't know, the DAX has been particularly keen on travelling this morning. We gapped open at the beginning of the session up to hit R1, that's yesterday's R1, I should say, not quite R1 from today, but actually as soon as we opened higher, immediate gap fill, and then we've driven lower down through the pivot at the moment, finding support at S1. Let me just zoom out on a 1 hour chart, but what you can see, and we were talking about this yesterday, let me just adjust a couple of these lines, let's just get rid of that one. What you can see here, and it's similar to the S&P, I guess, in that what's happening is we're really just consolidating the giant leap that in the end happened off Trump. And so you can see the last few days, and certainly Monday and Tuesday, all trading within that sort of Thursday, Friday range from last week. We've got a really big top to think about, which we didn't quite reach this morning at the open, and R1 today is on that, and that's the double top, post-Trump top, and it's actually, you might really call it a triple top here, with today's high and now subsequent reversal. So on the downside for the week, we've got a really clearly defined low for the DAX, just around sort of 10,660. Well, the actual official low, I guess, is 10,660. So we're kind of just drifting now down towards that. So definitely some action here off the equity space in a, I'd say a morning that hasn't been particularly eventful from a news flow point of view. But we'll talk about what's scheduled in terms of what's on the economic data calendar in a minute. But cable's been pretty choppy as well. We've just been down testing the kind of lows that we had around 5 a.m. and now we've lifted off that. The euro took a break briefly below that low point from Monday, so just very briefly a new low for the week set, and now we've bounced, so a little bit scrappy here on the euro dollar. Oil's under pressure. And let's just start maybe focusing in on oil. I'm going to go to a daily chart because that session yesterday was big, huge move to the upside. More than a 5% climb, best move since April, I think it is. Biggest single day gain, that is. You can see we ran out of momentum in the end, quite remarkably, at the $46 handle. Having started the day down at $43.50, and when you think about Monday's low down at $42.20, to hit 46, I mean 42.20 to 46 in the space of about less than 24 hours, huge move. I was talking about this earlier in the week, the idea that given the collapse in the price of oil over the last, let's say, 3-4 weeks, now we're down here, you're likely going to see OPEC start to talk it back up, and indeed, lo and behold, this is what's happened. So we've got it's nothing specific, but ultimately this meeting on the 30th of November, and you're starting to get some murmurings. So OPEC nations were making a kind of final diplomatic push towards sealing an output cut deal. So expect more chat on that. But what happened overnight really was slightly down on the day, but really we're just consolidating that massive move from yesterday. But we got a build on crude from the API inventories announced last night at 9:30 p.m. 3.5 million barrel build. So that perhaps for now will just be enough to halt the upside. Obviously we got some Department of Energy numbers at 3:30 this afternoon, but definitely oil a big feature of yesterday's session. So also, let's look at yields, because we've definitely had and I want to look at a daily chart for T-notes, because what happened yesterday, we had a day off, if you like, from this pattern that's happened since Trump's win, in that we've had a very large and consistent move to the downside on price. This is yields climbing, of course. Yesterday we actually reversed that, but you can see already today We're actually edging back down towards that low point that we had on Monday. So brief respite for this yield rally and price decline. It looks like we're kind of back on track. Something of significance is the fact, we've had this globally, right? The yields climbing. We've spoken about this already this week, but I wanted to show you, if I just change my screenshot here, what's happened that's quite significant or potentially interesting is this chart, which is looking at Japanese 10-year government bond yields. And the fact that yesterday we saw yields, and overnight we've seen yields up above zero. Now, when you look at this chart, this goes all the way back to the start, well, actually the end of 2015. But actually, 10-year bond yields in Japan haven't been above zero since February. So this is the first, this is a new 8-month, 9-month high. Now, the reason why this is interesting and something to look out for in the coming weeks, the Bank of Japan just literally, well, what was it, about a month ago, probably less than a month ago, changed course a little bit and introduced a new policy, and their policy was to essentially, well, make sure that 10-year bond yields don't go above zero. They have a yield target on the 10-year duration of zero, and little did they imagine that literally just a few weeks later they'll actually be called into action and have to start defending this. So it's going to be very interesting here to see what the Bank of Japan do now. I think they're a little bit probably regretting making that very defined commitment, and it's going to be interesting if they're willing to act and deliver that commitment. And it might be that this gets pretty tricky, because if we are seeing a pattern here where global yields are now, have bottomed, if you like, if you want to get really dramatic, if the 30-year bond rally is over, and when I say 30-year bond rally, let me just transition my screenshot back to my charts. This is what I mean. How far can I get my T-notes chart back? Okay, only to the start of the 90s. All right, so nearly. This is, if you go back to the mid 80s, basically bonds have rallied for 3 decades, and basically that's meant that bonds have rallied to the point where yields are zero, and surely that's not sustainable, right? So the idea is the 30-year bond rally done? Are we now going to get a secular reversal in bond prices? If so, the Bank of Japan have really called this 0% yield commitment at precisely the wrong time. It could be that this is going to start to get expensive, or they got the other option of saying, actually, you know what, only joking, we're going to scrap that plan. It's only 3 weeks old, but we're going to scrap it anyway. Obviously that would be a bit damaging for credibility. So this is something to look out for anyway. Okay, just in the coming weeks, next Bank of Japan meeting, what are they going to say about this? Has Trump triggered the end of the 30-year bond market rally? And if so, what are Japan going to do next? So that's something to think about. Otherwise, let's have a look. Sorry, just going to make that T-notes chart a little smaller here. So otherwise, let's have a look at the S&P. Generally equities were pretty flat for a lot of yesterday's session until the end. Now, I was looking at this sort of pennant that were really, again, the post-Trump rally consolidation pattern. And what happened, it was very sort of subdued yesterday, I would say, from an equity point of view. You had energy stocks definitely pushing higher off the back of the 5% climb in oil. You had financials actually moving lower. That's just profit taking from the big rally we've seen in financials recently. And so in the end, for the S&P, it was quite a neutral affair until, we got a bit of a technical break to the upside here. Obviously, the big data point yesterday, which was very interesting, was of course the US retail sales. And if we just have a reminder of the chart here in terms of what happened, this is the October reading was delivered way better than expected at plus 0.8%, and also a massive revision to the September figure. So this puts all of a sudden, a 1% followed by 0.8% back to back big growth here on retail sales. The best 2-month period for retail sales growth for years. If you have a look on an annualized chart, so year-on-year retail sales, then check out what's happened here, 4.3%, and you can see that's clearly the easily the best we've had for the whole year. If you go back to a 5-year chart, you can see that this is the highest annualized retail sales growth we've seen since, well, really the end of 2014. So you've got a 2-year high going on here. Add on to that, we've got other little statistics coming through. Check out this chart. This is the Atlanta Fed wage growth tracker, and they're saying check out wage growth, which is now surging and actually back to levels not seen since 2008. The Atlanta Fed GDP tracker for Q4 is now been revised up to 3.1%. That would be the best quarterly growth we've had again for like a couple of years. So like all of a sudden, you are seeing some interesting signs of some strength in this US economy. If this is nothing to do with Trump, really, is it to do with Trump? I mean, ultimately, these retail sales figures were for pre-election circumstances. This is October, right? The election wasn't until November, of course. So it's interesting to see if we get a return to strong data with then Trump arriving in office in January and delivering his fiscal stimulus. It's something, it could be an interesting situation. Whether this does actually lead to a successful fiscal strategy or not is another debate. But if we just flick back to the S&P chart, technically this kind of data in the end, and it took a few hours, but we technically broke above Monday's high, not Monday's high. Well, we did in the end, but we broke Tuesday morning's high. Then we broke Monday's high. Then we actually broke the post-election high as well, briefly. And then we've kind of tailed back off. So the S&P did indeed make a new, and if you just look back, I just want to get this right. Let me just take my pivot levels off here and go to a daily continuation. What we've seen is the highest price points since that high that we set, the kind of double, if not triple top for 2016, which is up at 21.91. So an interesting breakout there of the kind of post-election high briefly, but now we've kind of tailed back lower a little bit. So interesting on equities. Let's just show you. And what does this translate through to the Fed? Because we've got a meeting obviously coming in about 4 weeks' time. Here's a look at Fed probabilities now, given that we've had strong data, given that in the end we've seen a positive reaction in the near term to a Trump presidency. What this has led to is a almost 100% chance now of a Fed rate hike in December. So it's actually 94%. So this is a new high. You've got to go all the way back to, December 2015 to find the last time we had odds of rates going up in 2016 this high. Okay, so it's pretty much a shoo-in. But as I said yesterday, it's not really about are they going to hike or not. It's really about 2017 now. And how do you give forward guidance for 2017 when ultimately who the hell knows what's going to happen? The Trump curveball, it could go in about a million different directions. So very difficult for the Fed to really give us any kind of long-term guidance. They're going to have to, because this is what they've committed themselves to with their dot plot matrix that they kind of rolled out and wheeled out and thought would be a good plan for transparency. I guess they're kind of regretting that, but anyway, so we'll see what they think about 2017 at their next meeting, which is really more important now than are they going to hike rates at that meeting or not, because they almost certainly are. Let's talk about other stuff. Some interesting chat on the Supreme Court, from the Supreme Court here in the UK, just about Brexit, which has created a bit of volatility overnight. But if we look at cable here, ultimately the Supreme Court are potentially saying, and we had this spike higher last night on cable, and what the Supreme Court have said that you may well, the government may well need new legislation to be voted through to trigger Article 50. At the moment, the High Court ruled that you would need a parliamentary debate on triggering Article 50. And that's fine, that's one thing, but the idea that you need legislation to do it is a whole different ballgame. Speculation in the press saying this really could delay triggering Article 50 for as much as 2 years. But we'll see. I mean, this really will probably all come to light when we have the appeal hearing, because the government appealed the High Court's decision. They appealed to the Supreme Court, and that hearing's happening at the start of December. And we might get further detail on this. I think for now it's just kind of rumouring, and I don't necessarily think that that's going to happen. But we definitely had a blurt higher on cable last night as a result of this. That's kind of all calmed down a little bit now. Today's high is coinciding with Monday morning's European Open high, 120, just above the 125 handle on the futures, before we've tracked a bit lower now. So let's see what else. If we have a look at the economic calendar for the session, let me just change up my screenshot here. Yeah, definitely a busy, well, not that busy, but yesterday we had some important data, especially the retail sales figures. Today, less so. I mean, we've got some employment data out of the UK at 9:30, which at this stage in the ball game isn't really important, and that's because employment levels in the UK are very strong. In fact, well, the favourite stat of the government is that we've actually got more people employed, more people in employment in the UK now than ever before in history. That's the government's favourite stat. But 4.9% is the unemployment rate. The point is that, the employment or the labour market's solid for now. Obviously, Brexit turmoil, who knows, further down the line may well dramatically change that. But at the moment, it's not an important measure because it's strong, and we're not expecting that to change. So, it's not going to carry much of a market effect, this, at 9:30. And other than that, not much else. We got, that's it. Swiss data at 10, which isn't going to impact any of the markets we're looking at. So into the afternoon then, and we got some inflation data, producer price inflation from the US at 1:30. And then some housing data at 3, and industrial production in there as well. But as I said yesterday, I said US data is not that important. I wasn't expecting such a stellar retail sales report, but industrial production here is for October. I guess we are really just more interested in what happens post-election and post-Trump arriving in office. But really the best numbers of the day will be the Department of Energy oil numbers, and that's especially because of what's happened. Such huge oil price volatility over the last week, I guess. But, huge move, biggest up move for oil since April yesterday. And so, it really does put oil back to 46 or in the $45 region, which does now mean, there's definitely potential for large movement in either direction, depending on what happens with the Department of Energy figures that are due at 3:30. Other than that, more Fed speak, Bullard, Kashkari, and Harker. But as I said, really these days, there's such a high probability of a Fed hike that most likely this stuff's not going to change that. We've got Bank of England's Cunliffe on the wires as well from Manchester University. So that's the lineup for the session ahead. Just switch back to the charts to finish off. The other thing, interesting let's have a look at gold. Actually, I haven't talked about gold for a while. If we go to a daily chart, quite an interesting day, not quite, hugely interesting day for commodities generally yesterday. And that's because you had oil rallying 5% plus on the very same day that you had iron ore moving more than 7% in the opposite direction. A lot of the mining stocks yesterday got hurt, really hampering any upside because of the energy rally. A lot of the iron ore miners definitely got taken down. That's 2%. Iron ore dropped 2% on Monday and then 7% yesterday. So real divergences going on in some of these commodity markets. Gold, in the meantime, has just kind of settled down. We didn't quite reach $1,200, of course, in this sell-off since the election. If I just go to a weekly chart, where that 1,200 barrier is such a big level, as you can see, the lows that we had in March and then at the start of June. But I would say this is looking quite tasty now as an option for a good medium-term trade. Positives for that trade are the change in the inflationary outlook and the rise in bond yields as a result of that. Ultimately, gold should enjoy a bit of upside to inflation expectations. Secondly, we've got a lot of risk in front of us, not just with the Trump and the Trump effect and what's going to happen and what's not going to happen, but you've got this political shift globally going on, and is Italy next and is France after that, and where does that really take us? So you've certainly got some interesting risk factors out there that might flare up and lead to a bit of safe haven flow into gold. However, there are negatives to this trade, potential negative risks, and that's what happens to the dollar. What happens to the dollar's value? Does it continue to appreciate? If so, that's bad news for gold. What happens if Trump pulls this off? Trumponomics is the new buzzword, although the last time we had the leader of a country having a new branch of economics named after them, that was a spectacular fail. That's Abenomics. But Trumponomics, who knows? Who knows what happens, as I said. But if you do get this continued risk appetite in, let's say, the equity space, well, then, of course, that's not good news for gold prices. So it's quite an interesting dynamic. But I would say now that we're back down at the bottom of the 2016 range, then possibly it's starting to look pretty interesting at these price points. So there we go. That's it for the briefing, guys. The UK data is not until 9:30, but I would say it's not going to be that interesting. So it's about just keeping things tight. I think generally this week is a bit of I'd say just a bit of a transition week, after the explosions of last week's US election. And it's definitely a week of just figuring out, what happens next. You can see that in the equity space where we've had, consolidation patterns. But just keep an eye on bonds, I would say, just to kind of finish. I would say keep your eye on the bond space. And T-notes, do we get T-notes back to Monday's low? Is this bond market sell-off going to continue? And if so, well then fine. You might get extensions, or the dollar rally might continue. For example, that might have a negative effect on oil, given that it's jumped almost 10% over the last couple of sessions. So maybe I'd be looking towards bonds as the asset class that might lead sentiment. So I'll leave you on that note. Enjoy the session, guys. Thanks a lot.